Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
This is the Physician Sense Podcast. I'm Tyler Olson, joined by Chad Chubb, and we have a guest today. We're going to be talking about a timely topic that is quite relevant to the physician community, and we're looking forward to digging into it. Our guest today is Dr. Tarang Patel. He's a radiologist, and I've personally known him for some years. And Chad and I are going to be talking to him about, what are we talking about, Chad?
That very, very laid back topic where there's never any issues on syndications. Just real casual, laid back. But before we even get into it, again, thank you, Dr. Patel. I joked in our email, I feel like I've known you for years through just Twitter, but here we are live. You're our first guest ever on Physician Sense. So as we joked before, this is one that you will always hold the keys to this one. This is yours, my friend. So before we get into the fun of syndications, again, thank you for jumping on here with us. This is awesome.
Thanks for having me. I'll remember this. Hopefully other guests won't be, scared to come on after my performance and be like, oh, I can do better than that guy.
We won't have that issue. You're going to set a high bar here, and you're going to have a lot of people trying to take over your spot. So it's a good problem to have. So thank you again. Appreciate it. Tyler, where do you want to get started, my friend? This is a good one.
Yeah. Well, so investing in real estate is very popular, and it's understandably popular because there's money to be made. There's many tax benefit possibilities when you own real estate as an investor. And it's a type of investment that behaves differently from stocks and bonds and cash. So for those of you that are out of your training and you've developed a retirement plan, savings plan, real estate is often a natural next step to invest in. And so it is not surprising at all that this topic pops up in every aspect of every area of the financial industry and the physician finance blogs and podcasts and Facebook groups. And, there are genuine opportunities, and there have been for years. So this idea is not new. However, there is a new trend of trying to funnel money from specific communities into real estate deals. And so what we wanted to do is help you all to understand four things. One, what are real estate syndications? Because like I told you, I think of Mission Impossible when I hear syndicate, right? Because I love those movies, but that is not what we're talking about. This is about what is a real estate syndication or syndicate? Why and how did some physicians get started actually trying to offer and facilitate investments in these, even being fund owners and managers themselves? What has recently transpired that caused us to say, we should probably talk about this right now? And then lastly, how can physicians protect themselves when they're making decisions about investing in real estate? And Tarang, we would love to hear your perspective on these things, because I know that you've delved into this quite a bit, and I have some, Chad too, but we wanted to get your perspective on this. So, Tarang, if you're going to say something to someone who knows nothing about real estate investing, and they see real estate syndicate and they say, what is that? What would you tell them?
Yeah, syndication is basically a way to have multiple parties pool together capital or investment funds or whatever, and in order to purchase an asset, whether it's real estate, whether it's by a company, whether it's anything. It's just a way to aggregate through a legal entity a variety of sources of capital. And so, they've been around for, forever, I think, but they've become very popular, I think, over the last few years, probably last 10 years or so in terms of real estate, because, there's been podcasts and there's been YouTube channels talking about real estate, all types of social media. And I believe that the Jobs Act made some of these applications of syndications a little bit more, they facilitated this a little bit more. And then there's been software and companies that have been designed in the last 5 to 10 years that also facilitated the process. There was a lot of paperwork, a lot of verification, things like that. And so those things became easier to do in the last 5 or 10 years. And so the combination of those things has really made it interesting. And in real estate specifically, I mean, like I said, you could do this for any kind of asset, but real estate has always been an asset that's talked about for its tax benefits in addition to appreciation and the use of leverage also. So the combination of those things has kind of made it the perfect storm to get people into these topics, and doctors specifically, but any other high income people have been employees, especially. And as doctors have transitioned more to an employed model, they're W-2 employees, they have very few tax benefits. So this has been pitched as a way to reduce your taxable income. And we had very limited sources to write taxes off as an employed physician. So I think the combination of all those factors have contributed to the very significant rise in syndications over the last few years.
Okay. Yeah. Okay. Yeah, that makes sense. And it's important that you all know that real estate there are really good opportunities and they can be rewarding. I think the challenge here is that it can be overwhelming, the number of options. Like looking at some of the more popular physician finance blogs, and you look at real estate deals and you scroll through. I mean, there's lots of them. And just to drill into one, like Chad, if you're going to drill into just one syndication, don't you think it'd be a couple hours worth of digging, and it's like a rabbit hole, and it's a lot of time, right?
Yeah. And, before we jumped on here and went live, I was saying that the hardest part from the advisor side of it, and we're not anti-real estate. I'm actually a very big fan of real estate, just in different ways. It's one of those deals that it's hard to, even when we do get the materials from a client on, hey, I might want to put some money into the syndication, it's still a lot of what ifs, right? That a lot of that's not guaranteed. They haven't broken ground yet. We're still reading details. Are they going to be at full capacity? Is it going to take 10 years to get the full capacity? Do they never get full capacity? Do they foreclose in 5 years at an adjustable rate and we get, hammered down the line? There's so many moving parts that come to it. And same thing with regular real estate, right? My primary residence, if you go buy a multifamily, the same issues are there, but it's a lot more narrow, right? If it's only one home or one multifamily, or, you're going to buy a few rental homes, that's where, from our side of it, syndications are difficult. And to your point, yes, it takes a lot of time to review those and go through those. And, I joked with you, Tyler, about this when we were discussing it on, luckily for us, this isn't a very hot topic for our clients. They don't take the bait per se, right? They haven't been bombarded on social media. They didn't read that YouTube video where, one person bought into 1,000 syndications. Now they have a, 70-foot yacht. Luckily, they're using their own due diligence. And, we preach simplicity is beautiful, right? Some of my favorite parts are, we have a client with a net worth of $5 to $10 million, and you break it down and all it is a 401k, some backdoor Roths, a good taxable account. You're like, man, that's pretty darn beautiful. Simple, beautiful. So the long-winded answer, but yes, Tyler, you nailed it. It takes a while to review, but even there, you're still making some educated guesses and taking some educated, risk-taking per se on what that could actually look like at the end.
Yeah. So I think you touched on this a little bit, Tarang, but do you have I'm just curious, is there a specific reason or catalyst that made this situation, not just real estate investing, but now individual docs creating brands to then build a business around, creating their own syndication and teaching other people how to become general partners so that they can create their own deals? And is this something that's just happened in the last few years because the real estate market just took off in mid 2020 and a few people got lucky, and then all of a sudden they're like, hey, there's something to this? Is that where this comes from? The buildup?
Yeah, I think some of it is that you see other people doing something and you're like, let me figure out how they did it. And it doesn't seem like it's that difficult. I think in the last real estate boom, 2005, 2006, there was some of this. But again, we didn't have as much social media. And so it was more, word of mouth kind of thing. But there were people back then who were, physicians, dentists who were kind of accumulating small empires and then teaching people how to do it. But like I said, the technology now, the ubiquity of social media, this, the Facebook group phenomenon, all these things together have kind of contributed to that rise. And then I think physicians started, the whole burnout issue and the lack of control in your own physician practice, and the lack of ability to, when physicians used to own their own practices, they got some of these real estate benefits from owning their office, and so they had some of these things kind of inherently built in, and they understood some of that a little bit more just from simply, working and owning a practice. Those things are kind of gone for 70% of physicians now. They don't own their facilities. They don't own their practice. And so they start learning about these things via social media. It's not in the traditional, finance curriculum that many of us think about in the sense of index funds and set it and forget it kind of type of thing, But to be fair, most financial advisors, as you kind of said, it's not in their general realm to talk about this either. And so I think some physicians and just, people in general pitch it as, well, this is the thing your financial advisor doesn't want you to know about. And so some of that is there as well. Then the idea became, well, if my financial advisor is not talking about it, but, 80% of millionaires in America have, real estate as part of their thing. I'm like, yeah, but 80% of people in America also, who are successful own their own homes. That's their real estate, So I think it's all kind of an amalgam of factors that came together to bring this rise. And then, people started seeing, okay, opportunities were there. Airbnb ownership became a big thing in the last 5-6 years. And it took off, as you know, during the pandemic. So we had this confluence of factors arise. But I really do believe that the monetization of physician social media in the last 5 years has been a massive factor that was kind of under the radar for most. And most physicians feel like they're part of these trusted communities because they're only physicians in these communities or heavily physicians, dentists, whatever, whatever your profession is, there's a community for you. And I think most don't realize how much money is under the table of these communities and the incentive, whether it's, focused to real estate or short-term rentals or, whatever it is. There's a lot of that there. And I've seen it because I run a community that isn't monetized, but I've been approached by people saying, how are you going to monetize this? Like my podcast that I used to do years ago, how are you going to monetize it? I'm like, well, I really wasn't thinking too much about it. Don't get me wrong. I'm not opposed to anyone making money. But to me, just the trust that other physicians had kind of placed in me was paramount. And then if I could monetize, that's one thing, but I didn't let that, kind of lead me to where I was going. So yeah, I think, but inherently the main thing is I think physicians are trusting other physicians about things that are not medical. And I don't know that we wouldn't do that with other professions. So, I think we really have a special responsibility to kind of verify these.
Yeah, that makes sense. It's very easy these days with online marketing to create aesthetics and even like heart. I don't know if that's the right word, like a genuineness. And like even like, and I doubt that I don't think that there's, I like to just assume that there's no nefarious motives happening. It's just that people get ahead of themselves and they don't really think through the impact of offering something that they don't fully understand themselves. But it's like, it's very easy to it's a lot less expensive and a lot less time consuming to create a brand with good aesthetics and a good personality than actually doing the work of real estate development. And there are syndications that I know of that people like that I've not invested in them personally, but I know others that have, and they've been successful. And those companies, guess how many deals they're offering right now? None, right? And they haven't for the past 18 plus months. And it's because there aren't good deals. And so they're not going to just put some garbage together because they know when is the right time to do it. because they are experts. So,
I mean, I'll tell you this. I spoke to 7 years ago, a friend of mine who has multiple medical practices. He's also into real estate, but just as his own personal investing. He introduced me to his real estate contact here in Phoenix, and we had a meeting. This was probably 2018. And I asked the guy, that gentleman probably managed $1 billion worth of properties. And at that time, and he said, he's like, there's not much, that's prices out when we actually run the numbers. And so they sat out for a lot of the pandemic rise. We obviously saw during the pandemic a steep rise in those valuations. So in 2018, this was pre-pandemic, probably went up to 2 billion what he had, just from that rise. And then it's come back down slightly or whatever. But these guys had decades of experience in the field. And at that time, they felt like, okay, things weren't pricing. They didn't take into account what was going to happen. They just said in 2018, they weren't seeing anything that made great sense. Maybe little individual pockets, but not as a whole. And so I took that to heart. I was like, wow, these guys who have been doing these things for decades and been through multiple cycles. And that was the other thing is real estate, like most things, is cyclical. And so people who have been through with a lot of experience, and can kind of objectively say, yeah, it's not the best time right now. I was like, okay. And then to my surprise, I saw what happened in 2019, 2020, 2021, and early 2022. And you're like, what is going on? And everyone else is bombarding you with, oh, buy this. One of the things that really shocked me was a deal that was pitched to physicians about a market here in Phoenix. And Phoenix was probably one of the epicenters of this boom, specifically in multifamily housing, was, buildings from like the 70s that had tripled in value from 2017 and traded 3 times. From 2017, they traded in 2019, 2020, and 2021. I mean, literally flipping the way that people were flipping homes, or day, in a way, it's the equivalent of day trading stocks in that short of a time span. And you're like, this cannot possibly continue. Rents were rising, certainly. And for a very short time, they were rising at a 20% annualized rate. But that's not normal. And anyone who's been with any degree of experience would say, okay, you cannot continue to raise rents 20% a year to price your deal. But they did. They tried, they kept flipping these things. And I actually had the seller of one of those properties reach out to me because of my social media, and because I had posted something about it. And they said, yeah, we bought this a year ago. We had no intention of selling it, but someone came in with a crazy offer, and we can't believe how crazy it was, but we would be remiss if we didn't make the sale for our investors, but there's no way we would buy this stuff. Well, it turned out it was a group of physicians buying it, and fast forward 20 months, foreclosure, and it just didn't make sense. And I was like, it just logically, as someone looking at something like, how could this sustain? But in the moment, FOMO was very powerful. I think FOMO had a big role in this as well.
Even to piggyback off FOMO, the one thing I've noticed, and this was one of my more recent moments of getting more concerned about syndications, was, I don't know if it was the same group. We did see a few of the emails where we could verify it, and then others were just more or less doing it. But, where these syndications will say, hey, it's a minimum $50,000 buy-in, but all of a sudden a few months ago, it magically dropped down to 10 grand, and it was a once in a lifetime opportunity because it's only 10 grand. And my joke to them was, if they couldn't find investors at 50 grand, which you would argue, you're thinking maybe they're a little bit more sophisticated. They're probably, flipping over some more rocks. It's very concerning if they're dropping it down to 10 grand. I'm not saying it's horrible, but at least a yellow flag, maybe a mild red flag is up at this point. And I vividly remember that from a few months ago, because it was a few different clients, and even clients that did one-time plans with in the past, and were just like, hey, is this normal? Is this weird? And again, I'm not the syndication guru to say we see this all across the board, but it's common sense at that point. If they can't find enough people at 50 grand, and they don't really want 1,050,000 grand investors, right? They want the 250s, the 500s, the millions. They don't want to have to spread it out over 1,000 people. They want to get it over 100. So if they're getting that thin at that point, to me, that was one of those moments where I was like, ooh, this is a little bit scary right now.
Yeah. I think there's probably over the course of time, there's probably a few good deals or companies that they have expertise and they're patient and they go about it the right way. And how you find those, I don't know how to tell somebody. This is like, I mean, just except based on past experience, like from that one syndication that I mentioned to you, I know who they are and I do keep an eye on them. But it's just because I got lucky and like someone told me like, yeah, we made a decent return a few different times over the course of the past 11 years. And now they're just sitting there, not doing anything. And so I'm like, okay, they're worth putting on the shelf and accessing it later. But otherwise, you like go on to, you go online and you search, or you go to these conferences and, people talk about the different deals and that you got to go to these conferences because that's where the connections are made. That is not a good environment to make a decision like this. And so that's why, I like you do, Chad, too. Like my default is you want to invest in real estate? Why don't you go buy your own home first? If you haven't done that. And then if you want to get into real estate investing, then you could buy specific properties that can become your business. What you mentioned, and like another thing that was funny, what you mentioned, Tarang, about how like part of what's caused this to happen is that a lot of physicians don't own their own practices anymore. And I think that it is ironic in not a funny way that the way in which insurance companies have positioned themselves has a lot to do with that. And physicians that go into this space where they're trying to become the middleman and create a reason that they should exist is imitating the behavior of the insurance companies. Like, you don't need, like the insurance companies have legally and like with muscle, they have created a position where they are essential. And so obviously they're incredibly powerful, but anyone like you know far better than I do that they're not necessary to facilitate the, healthcare for individuals, but they are there. And I feel the same way about these sort of arrangements because we don't need these things. It's just that they're trying to create a reason that they are needed. And that's not a place where I want people who trust me to put their money.
Yeah, it's funny. I mean, like I said, these vehicles, syndications have been around for, a long time. I think back, there was a family friend who's an anesthesiologist, and they invested in the syndication decades ago. That was run, not very well publicized or whatever, but they, a few of them and their physician friends had put in money with a developer in the Midwest. And over decades, it turned into like an amazing source of an investment and funds for them. But they didn't go actively seeking other people. It was just a very closed kind of thing where, okay, this is a person that, I've had good experience with and I'll continue. They weren't exponentially growing like some of these syndications have been. Like during the pandemic, I saw one syndication that I actually had invested in prior to the pandemic that I just did a small amount to get an idea of how they ran. And I wasn't very impressed, but I had two small syndications with them and one turned out good, one turned out not so great. But I learned a lesson and I just wanted to get their idea of their process. That same person was able to raise millions in a very short time during these deals coming up in 2020, 2021. And I was just stunned. I was like, how are these people able to do that? But I just wanted to get an idea of the process. And so it was unbelievable that someone who had a long track record couldn't raise millions in that short of a time. And they weren't raising money during the pandemic. But someone else who had really 5-year track record at best, definitely not through multiple cycles, was able to raise millions because they knew how to go to the newer marketplace of Facebook and of Instagram and kind of broadcast themselves as a expert. What I find even funnier now is, and not funny in a ha-ha way, but funny, just unbelievable that their lack of self-awareness, is that these people are having difficulties, and again, there are external factors that contributed to the difficulty. So I'm not blaming any individual on deal performance going bad. I don't think it was intentional or anything, but they're now teaching courses on how to do that type of thing and teaching courses on how to raise money. And this is not just in the physician space. I've seen it in general real estate people as well.
So, Tarang, just to reiterate, the process that has now led so many real estate investment opportunities to get in front of the eyeballs of physicians. Could you just reiterate like why that's come to be?
Yeah, I think, it's technology, social media, all those things have made it easier to do these kind of things where before the process of, using attorneys to draw up these documents and then find all these people, build a community was, you were limited in that. It was expensive to draw up the legal documents. It wasn't, you go and talk to the local physicians in your group. Some people maybe had, were chief of a medical staff and had a smaller organization that other physicians knew. But it wasn't like you had a national presence and anyone could just build a national presence. With social media, they've been able to do that. And, it's great, right? Your podcast is an example of one of those things. Tyler, you definitely, Chad, both of you guys have developed a community of physicians. And, that community, whether intentional or not, just as human nature, we all kind of build trust in voices that we hear after a while. And it's a special responsibility to kind of deserve that trust, right? So, but it's been easy with technology, podcasting, YouTube channels, Instagram, whatever, to build these kind of communities. And then Facebook specifically has this big community feature that have developed multiple physician-only communities. And so I think that part, and then the legal structure with LegalZoom or all these online facilities to draw up these contracts has become easier. And so those things have risen together to make it pretty easy to, quote unquote, easy to develop these, syndications. And so I think a lot of people were learning. And then there was also, at the same time, there was a lot of these seminars to teach people how to do this kind of thing. And so people realize it's not that hard technically to do it. What's difficult is to do it well, right? And you can't, that's a different story. That's true of anything. And so I liken it to, you don't take a medical student who just finished a surgery rotation and let them perform surgery. And I feel like to a degree, and I'm not equating syndications with surgery, but there is a lot more nuance than what you would understand after your first, couple of rotations or exposure to a surgery. There's a lot more nuance that goes into it. That's why there's a 6-year residency for general surgery. And I don't think people appreciate the depth of knowledge that some of these other more experienced operators, like we were saying, the ones who weren't finding deals over the last few years, what they were seeing. What a lot of people saw was the ability, well, I can raise funds. I have a group of people behind me and here's the legal work. Let me go find deals. And there's always some transaction to be made. Whether it's a deal is in the eye of the beholder. And so to me, I think we saw the rise of transactions. We didn't see many deals. And that's what bothered me, was that there were just, like some of these transactions didn't make any sense if you really looked into it. And what really was even more of an issue was that, as you described at the beginning, the lack of, there's so many fees, there's a lack of transparency. We don't really understand, what all is standard. We complain as physicians. We've been educated now for a decade or so by boggleheads and the index fund people to complain about that one fund, 1% AUM fee for financial advisors. But they didn't realize that 3% acquisition fee on a property and then a 2% refinance fee and a 1% disposition fee and a 4% property management. I'm just making some of these numbers up, but all those things were there. And no one questioned those kind of things. So to me, there was transactions, there were opportunities, but there weren't really any great ones. And so fast forward to 2023, 2024, and some of those deals that have gone south, some of the same people are pitching courses on how to raise money and how to do deals. And to me, that part bothers me even more because I'm like, you're on one side having deals that, may have not completely gone south and they may be getting stabilized. They may not be. No one really knows. But on the same token, you're teaching people how to do something that you, in my opinion, didn't do very well the first time. And so that I have a big problem with. Like, how am I supposed to trust you now if I'm seeing the fruits of your lack of due diligence or the lack of foresight going on right now, simultaneous to that? To me, that's really what led me to call some of these things out. And it's not just physicians, by the way. There are some operators who are running billions of dollars doing the same thing. So this is, the physician operators are much smaller scale. I mean, that's more pertinent to this discussion, but it's happening at a much bigger scale in real estate as well.
The quote from the article that kind of triggered all this, where we kind of picked this up, us three really like last week, I guess, was, so the article's from The Real Deal. I'm sure we'll get into this next, but your describing that train was perfect here, because this is my favorite quote from it. It said, "Some people do it right, but more than half don't. Then one person is clueless, being led by another person that is also clueless about real estate." And I just started chuckling because, unfortunately, again, or all joking aside, I should say, that happens a lot, whether it's the physician community, the engineering community. I think the craziest part about that article to me was, it affects the immigrant communities. So now you have people that are not probably in the same financial spot as physicians and other high class or high income profession individuals. And the same type of, as you guys put it on there, and I joked with you, my favorite scene from The Office, where Jim's drawing the dashes, and there's one dash, and then two dashes, then four dashes. And then Michael's looking at him, and he draws the shape around it. And oddly enough, it looks kind of like a pyramid. And it's just, it's one of those things where, not to say every situation's like that, and there are good opportunities out there. I think the biggest thing is, one, it's that trust, right? You're coming in, it's a group of physicians. We'll keep it to physicians for our conversation. So you have that trust factor. And I think when you hear syndication, you assume it's real estate, but then everyone relates real estate back to like a primary residence. And like, the odds of foreclosure are so slim. I can manage my own home. I do everything right. The problem with these syndications are you're the smallest minnow in that pond. You have no control if that whole book, that $200 million book of real estate, is going to go belly up. And I think that's another hard part for a lot of people, is we equate real estate to our primary residence. And what are you going to mess up? Like, you just got to stop paying your mortgage? But we're not thinking that in terms of how massive these syndications are and how many risks are embedded in there compared to just like, Mr. and Mrs. Smith taking care of their home. I think that's another big issue in there, is we can't comprehend those or correlate those two risks.
One other thing that jumped out at me that I think is worth noting is that the language that is used in trying to pitch these deals or courses, I can tell that they're using language that is appealing to the career track of a physician. So, for example, listening to one opportunity that was being pitched, the person who was selling it talked about mentorship, and that, you don't know about real estate, you don't know about making deals, you don't know how to become this person, but if you buy into our course, we're going to mentor you. And that's a big deal in medicine in order to help you all, to help the new ones to come along, right? Now, mentorship, I've been reading about it. It's a tricky situation because mentorship can blend into coaching. And I'm talking about specifically with physician career development. And mentorship, from what I've read, people that want to maintain the standard, is that mentorship should be free of financial cost, because you're trying to pass along, you're trying to pay it forward to the next generation. So, and of course, this is not free. But the second thing, which I feel is more relevant, is that it sounds like they're trying to create this safe environment for a person to train in becoming this, general partner or real estate investor, where that don't worry, you're not alone. We're going to help you. And they may be genuine in this, but correct me if I'm wrong, Tarang, but like when a med student or an intern is training under a senior and they are being guided, the rules on how that happens and making sure that bad outcomes are minimized or completely impossible, as a result of the inexperienced one, those are built in place, right? So that the mentorship can actually be a safe place. But with this, there are no such standards. There's no oversight. This is just trust between this one person and you. And I feel like it's an inappropriate use of that word.
Yeah, I think you're right. I mean, in medicine, You have attendings, you have senior residents, you have junior residents, interns, medical students. There's a hierarchy that's kind of defined. And each level, kind of learns from the level above them and teaches the level below them. So it's, but it's been done for a long time. So there is a little bit of a established pathway there. What happens in this phase is, you just pretty much, you are trusting the person. And a lot of times you're paying that person. What I tend to find is even worse is that you don't realize, there's multiple levels of these payments. When you start with one course at maybe a few $100s, then you get to the next course, which is, or a meeting, which is a few thousand. Then there's a coaching circle. And then there's a elite private, thing. And all these different levels. I mean, there's, as you said before, the pyramid kind of level of these type of things, and you get better access and you get better training. And it's definitely initially seems very altruistic. And then you start looking deeper into it and you're like, whoa, what's that about? And there is no regulation. This is very much some people are very good about it and some people are not great. And there's been some very high profile non-physician real estate blow-ups in that exact kind of mechanism. The physician ones have paralleled that structure, but, just not at the same scale. But to me, we do trust each other. There's that, as you said, the physician specialties, the physician groups. Before social media, it was maybe, religious groups, maybe it was immigrant groups, maybe it was, other specialties, things like that. So we've kind of, I think that's partly our own issues as humans. And I like to talk to the people in my group that I always mention. I'm like, listen, understanding human psychology, and this is, a Charlie Munger thing that I learned about years ago was his article or his YouTube talk on the psychology of human misjudgment. And we started talking about it. It's perfect because Berkshire Week kind of just this past weekend. But, we started understanding that why we are susceptible to some of these things. And lucky for me, I learned it before I kind of fell into the trap of some of these type of things. But I learned that a lot of these communities were designed to encourage, for the good part, encourage good discussion, good education amongst the members, and a place that, as you said, Tyler, a safe space where physicians could talk amongst themselves without being judged, by the community of the general public saying, you guys make so much money. What are you complaining about? So these were inherently good things that over time, many have morphed into pretty significant money-making enterprises. And sometimes that portion of it overrides the discussion, the free discussion. I personally don't monetize my group, and it's a much smaller thing, so it's not really a big thing, but there are some much bigger groups that are heavy into monetization. And if you posted something like this article, you could be censored because some of the people are sponsors and some of the people make a lot of money from referring people to these things. And so to me, I really want physicians to be aware that, we always worry about the conflict of interest when someone in the insurance industry sells us whole life insurance. We've kind of learned to talk about that openly a little bit more now. But there's a whole other section of these types of transactions that most physicians are not aware of. And I really have made it something that I've been trying to discuss much more frequently on my social media.
I've noticed. Yeah. It's interesting that you made that distinction because anytime I bring up whole life insurance or other permanent insurance issues or inappropriate advice from financial advisors, I get a lot of like, yeah, we're with you. Like, you're right. We got to raise awareness about this. I have been consistently bringing up this issue for a few weeks, even like more than a month now, trickling at first, but more heavily recently. And there is no response. And I suspect, even based on some of our own discussions, there might be a degree of embarrassment, like where if anyone's like gotten in there and they're like, if they have some of their money invested in these things, they're not necessarily going to want to be like, yeah, I did that. Like, and I understand. But I also think that it might be, I have gotten some private messages, not scolding me, but kind of like, what are you, it seems like you're trying to put down entrepreneurship amongst physicians. And they are coming from a good place, these comments. They're not people that themselves are trying to just make money from these bad deals. They just are very protective of their own community. And so it's almost like these groups and these individuals that have built brands, they have a layer of protection that even if someone is met with the truth, you show it to them. I suspect that there are many who just cannot accept that this is happening.
100%, you're right. I've had similar messages telling me, and I am a physician and I'm in this space, and they say, hey, you're too negative against real estate. I'm like, hey, I'm not negative against real estate as an asset class. I think there are good times to buy real estate and there's not so great times to buy real estate. And just like any other thing, it can be cyclical. But B, they're like, why are you so upset with physicians? I'm like, I think we hold each other to a higher standard, and so we trust each other more, but there's a responsibility with that. And I don't think that, I think we as individuals assume that everyone has our best interests for us. And I'm scolding the physician themselves a little bit, but we all make mistakes. But I'm like, just understand you are trusting someone that maybe you don't really know yet. If it's deserved, great. And, it's easy to make small mistakes, and that's fine. And that's what I did initially, was I trusted someone and I invested with them a little bit to learn. But, after a couple of getting a better look at their processes, I learned, okay, I'm not doing that anymore. I've had people reach out to me that have sunk, 6 figures or more into some of these deals, and they're not happy with the results. And some are happy. And like you said, some are vigorously defending these. And that's okay. I mean, listen, I'm not saying that I'm 100% right by any of these things. And I'm not saying I'm 100%, I would do right in the future. But I think for me, the thing that I was looking to do in my social media was I just wanted to educate physicians because I've made mistakes. And I didn't want to be the person who takes that trust and potentially misuses it. And I'm not saying that people are doing this intentionally, but when money is offered, people start getting various, their incentives change and their behavior changes. And so, I think we should just all kind of be aware of these things and discuss it. And it's okay. You can make these deals. You can sell these courses. You can do whatever. But understand that there are options to learning things. There are options to investing. And it's okay to not do what the community's always doing.
Well, thanks for sharing. The last section I wanted for us to cover was, action. What sort of things can physicians do to protect themselves? So obviously, like being able to, we've talked about awareness and understanding these incentives, but and I think that this hypothetical is probably a fairly common point at which someone would seriously consider investing in real estate. They've finished training, they've paid off, certainly credit card debt, and they've got, they're fully funding their retirement accounts, backdoor Roth IRA. They're putting money into a taxable account. They feel things are getting robust, and they might be feeling confident, like, okay, now it's time to get serious. I want to create passive income. They're trying to think about like early retirement or work optionality, those sort of things. And so they're like, I should look into real estate. Are there, like, I can think of a few things, but I'd love to hear your thoughts, Chad or Tarang. Like, what would you do? Like, what would you say to someone in light of these developments?
I'll go first only because I'm going to keep it short and let Tarang get a lot more here. I think, Tyler, you and I see eye to eye on pretty much every financial planning topic. And I think you described the situation really well. There's a lot of boxes we want to see checked before we get into this conversation. And in full fairness, I'd use that same list, whether you're going to go buy a multifamily on your own, a syndication, or, investing into your office building. And I know we touched on that earlier too, but for our physicians that have opportunities to buy into their office building or their surgery center, like, to me, I'm like, that's always our slam dunk before we even go down here. So I think the real estate conversation comes a lot later. And in most of those scenarios that you just described, Tyler, I keep coming back to the primary residence, but so many people forget to include their primary residence as real estate exposure. Don't think of it as an investment, right? You didn't buy your, like, two things I hate. Well, it's an investment and I bought it for the tax benefits. I'm like, ugh. That's not why we buy homes, right? That's not why we buy homes. So I'll leave it at that. I agree with what you said, Tyler. And, there's a lot of boxes we want to go through before we get to that conversation. And then even when we get to that conversation, there's a lot of due diligence, a lot of deeper conversations that need to be had. But Tarang, I'll pass it over to you and you give us your thoughts there.
Yeah, I think you bring up good points. I mean, there's a stepwise approach, and real estate is certainly a very good part of someone's overall asset allocation. But there's many ways to learn about it. I mean, you can take a course if you want to, but there's books, there's, for syndication specifically, there was a good book by a guy, Brian Berg. I think it's called The Hands-Off Investor, $15 on Amazon. And it's pretty dense, but it's very well written. And if you're going to drop 50,000 into an investment, it's worth spending a few hours, 3-4 hours, at least going through the checklist that this guy kind of outlines in his book. And I mean, if you're not willing to do that, then put it into, an index fund, put it into a REIT. I mean, it's harder work, and that's okay because there's potentially better returns and tax advantages and all those things. But if you're not willing to put in that level of work, and I'm not talking about the dollars to go to a course, I'm talking about just simply reading, especially, with the audience here as physicians, you can understand this stuff. It's just, it's a little bit dense. That's okay. But if you don't feel like that's worth your time, then don't think that the course is going to make you any better, or that being an LP in a general syndication. I mean, I don't think the term limited partner LP is it's a good term, but it's very limited is the information that you're getting. You're not getting much, you don't know the whole scope of things. And this type of book at least will give you some, an outline of questions to ask. It still doesn't mean you're going to get all the information. But yeah, I mean, like I said, I do believe in real estate as an asset for people, even though I'm not heavy into it myself. But I think just like anything, there are times to do it. And 2021 was not the best time to do it. I honestly think right now the opportunities are slightly better, but the interest rates kind of cancel some of them out. But the deals may be slightly better than they were in 2021. But it's, again, just a timing thing. And you kind of have to understand market cycles for that too.
Would you agree that someone is better off not investing in real estate if they're not willing to really invest the time to know what they're doing? Like beyond like a Vanguard REIT or something like that, getting into complex things. Would you agree that it's better to just keep things more simple if one realizes in themselves, I'm not in a position to mentally do the work here so that I actually know what I'm doing?
I think it depends on are you okay with losses? And not saying that you're guaranteed to lose money, but if you're putting in a certain, let's say, 1% of your total portfolio valuation into a real estate investment that you don't really understand, and you're okay with losing it, and it's not going to keep you up at night, but you're trying to learn something about it, just, even small amounts. Maybe you're not putting in the full effort, but you're trying to learn how the person who's running this deal works. I think it's okay. And I think you'll be okay. But yeah, for the average person, if this is going to bother you a lot, then don't do it. And I think you'd be better off just for, even if your returns aren't any better, for peace of mind and for simplicity's sake, to just go into, the index fund. Because, that's as low effort as possible. And there's something to be said about low effort. We've got everyone's got a lot on their plate. And adding real estate is another thing that you're adding. And it does require some work because it's not as transparent as some of these other potential opportunities are.
I can see that. Just dabbling a little bit. Sometimes a client will say that they want to take like $5,000 and put into some stocks. They're like, I just want to pick some. And, of course it's their money, so it's up to them. But they're looking for some sort of validation. And if it's a very small percentage, there's nothing wrong with it. They can definitely learn something from that. And maybe they'll make some money. Maybe they won't. But it sounds like a very similar principle. In that case, it's just like, it's okay. It's a learning opportunity, and it's just a tiny, tiny bit of excitement. So I can see the merits of that. I think there's so much fear of missing out in many aspects of life for physicians, home ownership and just life things. And the fear of being trapped it's genuine, and I want to support you all finding the right solutions for you. But what I wanted today to be about is helping anyone who's thinking about this, like right now, or maybe they will in the future. They will realize you don't need to jump rashly. You can take your time, because it's not necessary. There's no once in a lifetime deals that are going to be made available for $10,000, right? So, well, thanks a lot, Tarang, for coming on and joining us. It was enlightening, and we want to be able to provide good information for people to chew on. Was there anything else that you wanted to share with us before we part for the day?
No, thank you. I enjoyed the conversation. I appreciate the opportunity.
Thanks, Tarang. This was a great first guest appearance. We couldn't ask for anyone better. So thanks for jumping on here with us.
Thank you, guys.
All right. See you around.
Bye.
This information is for general purposes only. This information is not intended to be a substitute for specific professional, financial, or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Heals advisory services and financial planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state registered investment advisor.